Welcome to The Explainer. Today, we're diving into a big one, SACCOs versus money market funds.
Okay, so you've got some money saved up. That's great. But now you're facing a massive question. Where do you put it? In the financial ring, we have two heavyweights in Kenya, the SACCO and the money market fund. Getting this choice right, well, it could literally change your financial future.
So, we're going to break this down like a 6-round championship fight. We'll look at how they work, the returns, how fast you can get your cash, and a secret weapon one of them has. Let's see how they stack up.
All right, let's get right into it. Round 1, the tail of the tape. Let's meet our contenders.
In one corner, you have the money market fund. Think of it as the liquid sprinter. It's fast, it's flexible, it's all about quick access. And in the other corner, you have the SACCO, the powerhouse builder, designed for long-term financial muscle. Two very different fighters.
So for round 2, let's pop the hood. How are these things actually built? What's really going on behind the scenes? Okay, so a money market fund, or MMF, is basically a giant pot of money. You and thousands of other people put your cash in, and a team of pros manages it. They invested in super safe, short-term stuff like government treasury bills. You're pooling your resources to get a piece of a much bigger pie.
Now, a SACCO is a whole different animal. It's more like a financial club that you actually own a piece of. It's a cooperative. All the members save their money together, and that big pool of cash is then loaned out to other members. It creates this amazing loop where your savings are directly helping someone else in the club get ahead.
And now for the round everybody's been waiting for. Round 3. Let's talk about what really matters. Which one is going to make you more money?
When interest rates were high, money market funds were on fire. I mean, they were posting some seriously incredible returns. A lot of the top funds were offering well over 17%, just by riding the wave of high yields on government debt.
Just look at this number. At their absolute peak, some of the star performers were hitting an 18.2% effective annual rate. I mean, wow. For an investment that's low risk and easy to access, that is a fantastic return. But now, let's look at the SACCOs. And what's really interesting here is the consistency. While MMF rates can bounce all over the place with the market, these big SACCOs, well, they're titans. They have a long track record of delivering strong, stable returns year in and year out. And the numbers, they are just staggering. You've got major players like Tower SACCO consistently paying a massive 20% dividend on share capital. And on top of that, they're paying 13% interest on member deposits. Those aren't just good returns, those are powerhouse returns.
Okay, but here's a plot twist. The gross return is one thing, but what you actually get to keep is what matters, right? And this is where the government steps in and delivers a pretty heavy blow to MMFs. Your earnings get hit with a 15% withholding tax. SACCOs? A much, much gentler 5%.
And this chart just shows you the result in plain numbers. Let's say you invest $1 million shillings. After the taxman takes his cut, the SACCO leaves you with an extra 30,000 shillings in your pocket, just because of that tax difference. That is pure outperformance, right there. So, it seems like SACCOs have the edge on what you actually take home. But what if you need that money, like tomorrow? What happens when you need to make a quick getaway? This brings us to round 4, and it's all about liquidity. It's just a fancy word for speed. How quickly and easily can you get your hands on your cash when you need it? And in this round, money market funds score an absolute knockout. No contest. They give you a huge advantage. You can get your money in just 1 or 2 business days. Your core SACCO savings, on the other hand, are built for the long haul. They're locked in. The only way to get that cash out is to resign from the SACCO and give a 60-day notice.
But wait, the fight isn't over yet. This brings us to round 5, and the SACCO's secret weapon. This is a powerful move that the money market fund just does not have in its toolkit. And that secret weapon is the credit multiplier. This is an absolute game changer. See, your savings in a SACCO don't just sit there. They act as collateral. So with $500,000 in deposits, you can often borrow 3, 4, even 5 times that amount. That gives you access to serious capital for big life goals, like buying land or a car.
A money market fund? By contrast, it's a one-way street. It's a fantastic place to save your money, don't get me wrong, but that's it. You can't borrow against it. It offers you absolutely zero leverage. So, after 5 intense rounds, who's the champ? Who's the winner? Well, you know what? The truth is, it's not about a knockout punch. It's about building a winning team for your money. The real winning strategy isn't to pick one. It's to use both of them and let each one play to its unique strengths. Think of it like this. Your MMF is Tier 1. That's your goalie, your emergency fund, fast, liquid, and safe. Then your SACCO is Tier 2. That's your striker, your engine for long-term growth, supercharged by those amazing tax benefits and that incredible leverage.
So the key takeaway here is to let each vehicle do what it does best. You use the MMF for agility and safety for all your short-term needs, and you use the SACCO for its raw power to build serious long-term wealth and buy assets.
And that leaves us with one final thought for you to take away. Take a look at your own finances. Are you just saving your money, or are you strategically positioning it? A truly strong financial plan needs both a solid defense for life's surprises and a powerful offense to help you win the game in the long run.